you exactly what to look for when understanding liquidity inducement traps and how to stay out of their way. So first and foremost, it's important for you guys to understand what is liquidity. Well, simply put, liquidity is just another word for money, and money is where the stop losses are. So any area in which there is a stop loss, that is what we refer to as liquidity. And we know now 95% of Forex traders do lose money, and therefore 95% of traders are liquidity inducement. So by understanding what the typical Forex strategies are out there, your trend lines, support and resistance, double tops, double bottoms, and all of these types of strategies, that is our liquidity. So just giving you a brief example, let's say you have here a double bottom, and this right here is our liquidity. But for a lot of traders, they are looking to actually get involved in the market here by putting in long positions with their stops just below and more than likely targeting the high for the most part. Then you have the opposite end of the traders, and those traders are the breakout traders. And those traders are actually opening sells when that level breaks, because you know that is a break of support, and so price for that reason should go down. And what we'll see for the majority of the time is, you know, traders might get tagged, both of them might get tagged straight into their positions. Now the sellers have been induced and the buyers have also been induced. Price will tag out the sellers and continue to the downside. And we will notice that time and time again, both of these traders end up losing their trades. And that is where we get the statistic that 97 or 95% of traders actually lose money. Then there's also, of course, your trend line, right? Whilst price is, let's say, trending to the upside, and we have a trend line forming, right? And it doesn't matter even if this trend line is trending up and down, the trend line is this. It doesn't matter what happens internally, which is the big mistake that traders make, is they're looking for pattern recognition and not actually allowing the price narrative to play out. So here we have a trend line that looks like price is increasing, and thus liquidity down here, because the traders are trying to get involved here. And then of course there is the opposite end of the spectrum, which is the traders that are going to short if we break the trend, because then they will assume we've shifted bearish. Now here's what's going to happen to most of those traders, right? Some are going to open long, some are going to open shorts, and you're going to see the same thing happen again, right? It's going to take out the longs more than likely pretty much straight away, tag in the shorts, but then go and mitigate our level of supply, which smart money traders know, before then continuing. And we understood this pretty simply put because we had our shift of order flow right here when price actually started to resume bearish. And so there would have been levels of supply left behind that we would have then been able to position ourselves into. Now, this is great because we are able to understand before we get into our positions, liquidity has been taken. And as a result of that liquidity being taken, the banks then can continue to move their positions in alignment with whatever they want. Let me show you multiple examples right now, because these examples are playing out all of the time. So right now I'm just on the daily time frame on GU. You can go to any time frame, any currency pair, and you'll see the same thing play out. The first thing I do see is when these highs go here, this is one form of liquidity because that is a sweep to the upside, right? And essentially what that means is there are these traders that trade breakouts, and now the highs go. And so what do? They try to trade long with their stops below, God knows where, if they're targeting, and there's that type of trader. And so that's exactly why that this wick takes over this high, because that is to induce our liquidity. Now, then there's other traders that are looking inside, and they're looking at this as a sign of resistance. Price comes down, pushes up, taps down, pushes back up, taps down. And so they're now trying to look to get into shorts, right? And lo and behold, price tags them out. And then there is the traders that see the double bottom, right? This is the prices came, respected this level for absolutely no reason, pushed up, came back down, respected it again, and so when price revisits this area, we know now we found a level of support. And lo and behold, of course, as price comes back down, they get tagged out. But then when they get tagged out, price then formulates this low. And what do we have then? We have another perceived area of support. Price taps in, comes back down, taps in, away, taps in, away, taps in. Okay, let's get involved now. Price is respecting this key level for absolutely no reason other than to build up liquidity to take it. Now, what else do we have? We have the opposite side of the spectrum. There are traders that are trading these things called breakouts, in which case they are actually trying to short out of this level once it gets broken. And depending on, where traders would have put their stop losses, I mean, if you would have covered these highs, then you actually would have been in profit, which is a rare occasion for retail traders. But of course, that has to happen for a number of times to keep them on the hamster wheel, because if every single time their strategy didn't work, then they would stop trading the strategy, and thus there would be no more liquidity. So lo and behold, if you would have put your stops above there, you would have stayed in the trade. For a lot of traders, they are greedy and they would have tried to put their stops in here. Okay, here's the last point. Here's where we broke from. Stops above there, and they would have got taken out of the market. And so you can very clearly see a number of occasions in which retail setups have occurred and thus been stopped out in such a pre-designed way that it actually becomes suspicious. Now, if I was looking at this market as a smart money trader, which is the concepts that we do create here in our academy, it would just be simple, right? The first one would be to understand that the change of character has occurred, and therefore, we are significantly overextended to the upside. And so a pullback, of course, also factoring in the fractal nature, I would have to understand the other time frames also. You can't just operate everything on one time frame. We have to understand the whole picture. But just for this video's sake and this time frame, there's our change of character. That simply means there is more supply than there is demand, thus price will decrease. Our supply level that causes the change of character is here. And as you can see, that supply level does get wicked out absolutely very slightly. And now it depends on how much of a greedy trader you are. Like, had you just actually give a little bit of a room to breathe for your stop loss, you wouldn't have got taken out. But let's say you are the greedy type of trader who would have put their stop loss right there, not give any room for liquidity sweeps, which is a common occurrence, and you would have got stopped out. Okay, but now we understand, okay, it didn't close with a candle, which is suspect for liquidity. So what did happen? Well, we did sweep the high, and then in actuality, we did then go and take the lows. So when we went and took the lows, be it our break of structure to the downside, we can see the continual decrease. Now, if this was me personally, I would be taking a short from this supply level right here and looking to take down the lows. Now, you can see in this scenario, this short wasn't tagged in, but that's okay, right? Because setups always occur themselves, especially when we are trading in alignment with the trend. So lo and behold, another break of structure to the downside, which thus gives us another opportunity. Now, our new supply range is in here, and that would be our entry. If you're new to the channel and you don't already understand how we define supply and demand zones, we do have other videos on this specific topic on our YouTube channel. And for more information about all of this, we have much premium secret content that we do sell, to be quite frank, and that is situated in our description box down below. So you can see that our second entry of supply tagged us in. And, you could take off some partials or go to break even when these lows go. There's trade one, and then, of course, you can see we break again. And so just continuing here with the already apparent theme, here is our supply range number 2. And so there is our second trade entry. And as we take out more lows, you can see, okay, the lows get taken out again. And there would have been your third entry, and you would have missed the tag. And that's not a problem. And then there isn't really much of a setup opportunity from then based on our strategy, on our concepts, right? Because this isn't our exact strategy that we do teach inside of our mastermind and our mentorship. This is the concepts on diversified timeframes. So the concepts stay the same of the breaks of structure, of the liquidity, of the supply and demand. But on these scenarios, they're just situated on different timeframes, but albeit the same concepts. And that's great news because these concepts are universal. And so you don't need to go and take our course if you can piece all of the puzzles together. But of course, for those who want to fast track that process, we do have premium products available that gives our entire strategy from A to Z, all the time frames, all the criteria, and all of the fractals and breaks of structure and the 3 different structure types. There's a lot of things that go into this strategy. It's not as simple just as a break of structure and enter. There are different elements to it, but at the same time, a simple strategy can be built around these concepts just based on what I've just showed you. If you understand prices trending, and you can literally just take shorts or longs in alignment with the trend from areas of supply and demand. You literally can do that, and you very much will be a profitable trader. The reason that we have a different strategy is because we can go down to lower time frames and get higher risk to rewards and more trades. This is on a daily time frame, so you would have had 2 trades in a very long period of time, and that's why we execute our trades on the 1 minute time frame, because it's the same concepts, right? This chart will look no different on the 15-minute in just this piece of price action, which is trending down. There's many trade opportunities in just this one. That's why we trade the lower time frames. But the systems are the same. Supply and demand, order flow, fractals, liquidity inducement is all the same stuff. So guys, if you did enjoy that video, please do go and subscribe to our YouTube channel. It really does motivate us to put more content out on a continual basis. If you did find this video valuable,